Hey there, Brian Daywald at Fairway Independent Mortgage. Wanted to chat with you about a super common misconception. This happens every time the Federal Reserve adjusts the federal rate. I get calls about it, and it's very, very common misconception. I've personally heard ads on the radio and on the television about cuts or hikes. So I'm going to give you 4 examples, or 4 bullet points, I suppose, if you will, about what actually happens when the Federal Reserve moves their numbers and how it doesn't have a direct impact on a mortgage rate. Okay, so the first point is that the Federal Reserve does not control mortgage rates. Again, very common misconception. When the Federal Reserve is meeting and determining what they're doing with their interest rates, they are moving rates in anticipation or for a reason. Typically, when they cut rates, they're trying to just balance things out in anticipation. Maybe they're trying to send the stock market a little bit higher. Maybe they're trying to avoid recession, but that's usually the game plan for the Federal Reserve. It doesn't have anything to do with mortgage rates, as a reminder. It's in anticipation of future market information. The second point is what the Federal Reserve is doing is they are setting the federal funds rate and what they call the discount rate for basically the amount or the rate where very short-term loans are put together. So this could be from bank to bank. It could be from the Federal Reserve to a member bank. They are, again, very, very short-term and doesn't have anything to do with the long-term picture like a fixed rate mortgage. All right, so here's point number 3. Typically, when the Fed lowers interest rates, they're trying to get stocks to rebound. If stocks are falling a little bit, sometimes, again, maybe to avoid a recession, they'll lower the federal funds rate. Sometimes it's 0.25%. Every once in a while, we'll see 0.5%, but it's commonly 0.25% at a time. So when that happens, traditionally stocks will rise, which causes bonds to fall. And a lot of times, the vast majority of the time, mortgage prices and mortgage rates are based on bond markets. It has to do with all kinds of Wall Street type stuff. But when stocks rise, traditionally bonds fall. And when bonds fall, mortgage rates rise because the value of the mortgage decreases. So hope that helps clear that part up. All right, and last but not least, the 4th point is that the mortgage market moves all the time, kind of like stocks move up and down all the time. Our market works the same way. So a lot of times there's anticipation of what the Fed is going to do, and the mortgage markets are already adjusting just like stocks are. So it's not a one-time kind of a snapshot of, rates are here and then they just drop. Again, the 3 points earlier, but there's a lot of anticipation. If investors feel like the Fed is going to do this or that, they're already anticipating some of those moves, and markets adjust accordingly. So hope that helps. I appreciate you watching. Hopefully that helps clear up. Sorry for all the nerd talk. Happy to have a conversation with you about it if you have any questions. Take care.